Hello, everybody. This is Ted Bauman here, editor of the Bauman Letter. This week, a different view on your screen. It's not just me. I have my colleague, friend, and Billy Gibbons impersonator, Clint Lee, here. Here's a picture of him. Um, you can't really tell the difference between him and that Texas great guitar player, can you? Clint, how are you doing?
I'm doing well, thank you.
I bet you didn't know I was going to do that to you, did
I did not. I shouldn't have shared that photo, I guess now. I know
I
better for
got it.
next time.
I have it. I have it. It's going to be up on the video. So okay, what's been happening the last couple of weeks and months is we've been talking about scenarios for the election. Like a lot of other people, particularly on Wall Street, people, we thought, this might be a blue sweep, and that would be bullish for value stocks, particularly those related to renewables and to utilities and infrastructure and all the things that might have benefited from a unified government and a spending package. Now we know that we're almost certainly headed towards a split government. There's a small chance that might not happen, but not much of one. It looks like Biden is going to squeak out the election. So we're assuming that we'll have a Democrat in the White House, Republicans in the Senate, and Democrats in the House. Now, what does that do? I mean, how do we interpret this from the perspective of history? First of all, what happens when markets go up big time like they did yesterday and are continuing to do today?
Typically, at least historically, it's been a positive sign of things to come. And I wouldn't necessarily just hang your hat purely on this at the end of the day, but anytime the markets have been positive on the day after the election, it's been positive for the markets looking several months into the future. And here's a chart to show this. This comes from Sentiment Traders website, and they went back and looked at all the one-day performances after elections going back at least 100 years or so. And what we're showing here is what the markets tend to do when you have the day after a positive performance, which was obviously the case on Wednesday this week. Mm-hmm. And what you can see is that historically, what I'm really focusing in on is just at least the 3 months after that day. 90% of the time, the markets are higher by an average of about 4.5% or so, in the aftermath of the election. So just purely based on the market reaction, that's a good sign here going forward.
So we did see just a complete turnaround in market sentiment, literally in the course of a few hours. And I'll come back to that in a minute, but how do you interpret this? I mean, what kinds of stocks are going up and why are they going up?
Yeah, well, it's kind of back to the status quo trade before the election, really. I mean, if you looked at the couple days leading into the election, it was interesting because you saw that cyclical rotation. You saw that value trade. You saw those areas of the market absolutely surging in performance relative to the growth space, anticipating sort of what the polls have been telling us, that there was going to be this blue sweep. And then, as you mentioned, I mean, as it unfolded on election night, that was not going to be the case. It was a very quick unwinding of that trade, and that carried through to Wednesday, to where you saw growth names, tech names, absolutely leading the way higher. I can't remember exactly off the top of my head how small caps ended up on the day, but they were barely positive, if I recall correctly.
Right. I don't want to show a chart that reinforces what you're saying. This is a chart that shows futures trades for the Russell 2000 divided by futures for the NASDAQ 100. So basically small caps versus big tech. So as you can see, in the early stages of the election reporting, the small caps rose. I mean, futures bets on small caps proportional to the NASDAQ rose very dramatically. And then look what happened. Once you get out of that blue zone, they just went down dramatically, and so did bond yields. Now that tells us that when the market realized that the Democrats were probably not going to take the Senate, they concluded that it was time to switch back to what we've been doing all year, which is basically to bet on growth, because growth stocks, all else being equal, do better if you have low taxes, if you have low interest rates, and if nothing else is attractive. And I think that's an important part of the piece we shouldn't lose sight of. But the fact that we do have, are looking at more gridlocked government for the next 2 years, and probably a lot of contestation. I wouldn't be surprised to see some excuse for an impeachment. We might see battles over the budget and all that sort of stuff. That means that the stocks that people were hoping were going to recover because the government was going to be spending money into the economy, all those hopes are dashed. We saw some up and down and back and forth with renewables, which is interesting because there was a huge sell-off yesterday, but today it's the exact opposite. So it's not 100%, but basically all the bets that were on spending from the federal government stimulating the real economy, where the small caps live, are off. And now we're back to where we were. The question for me, Clint, is it a sustainable trade? I mean, at what point does these 2.5% daily jumps in the stock price of companies that are already at valuations in excess of 30, sometimes in the case of Amazon, just astronomical? How far can they go?
They can go for as long as they want until investors start to change their mind, really. I think the number one thing I would probably watch right here is 10-year treasury yields. That was something I was watching closely going into the election, especially if that blue sweep scenario unfolded. But really, I mean, there's three things right now that is really helping the tech trade. One is the interest rate scenario. Yields didn't jump; they fell, so that's helping push valuations higher. But then with the prospect of gridlock, there's probably less of a regulatory threat to the tech space. And it looked like tech was going to be disproportionately impacted by taxes, especially if corporate taxes were to go back up. But it looks like right now, all those things are off the table. And so it's a bit of a relief rally, but, at the same time, it doesn't, to your point, help the valuation scenario. But I think, going forward, I'm still watching yields as sort of the number one thing. If yields stay contained here, if they stay low, that can help prop up valuations, help support valuations across the market. But if you do start to see yields creep higher, especially start to get above, it's crazy to think about a 1% on the 10-year treasury. But if we start to cross back above 1%, I think that starts to put pressure on the valuations of these growth names. And that would be sort of the catalyst to see some downside there.
Right. And there's some other factors I think that have been overlooked in this whole exercise, particularly relating to, strangely enough, the tax situation. A lot of people are not aware, but one of the ways that the Republican Party managed to pass the 2017 Tax Reform Act was by building in tax increases starting next year. And what's interesting to me is that a lot of people don't realize, but the taxes on everybody except for those earning more than $100,000 a year are going to actually be going up. In other words, the effective tax rate is going to be going up, which means that that's going to cut into the incomes and spending ability of people who are already stressed by the pandemic. So that's a double whammy, I think, for the small caps and for the domestic sector, which again raises a question of where else opportunities might be found. I mean, if we know that the tech sector is already highly valued. We know that it's being driven by policy variables like interest rates and whatnot, rather than really fundamentals, although they are selling goods. And if we know that the domestic economy is not going to provide the opportunities, we've been saying look offshore. And I want to show a chart that shows two ETFs that cover the offshore trade that we've recommended in the past. One is EMQQ, which is an emerging market internet oriented ETF, and the other one is EEM, which is just generally emerging markets. You can see just in the last 2 days, both of these have just skyrocketed. I mean, EEM is up by over 7 or 8% just in the last few trading sessions. EMQQ is, EMM is also a big time, keeping track with the S&P 500. So for me, I think the one thing, what we have been saying in the past is off the table, and that is that if there were a clean sweep, that you could start looking for good bargains in the value sector now and potentially make some money. That might still happen in some pockets, but generally, I think that's not going to happen. If you're right that eventually investors will start to get tired or wary about the tech sector, I still think the emerging markets and offshore stocks are the place to go. Do you agree?
Yeah, I do. I mean, we've talked about the valuation differential in those spaces before. Especially on sort of that cyclically adjusted PE ratio where you're smoothing out earnings. But the one thing that I would watch for there right now as well is the dollar. We saw the dollar trade in a pretty wide range as election results were coming in, but it's been weakening here just over the last day or two now.
Right.
And really, there's on the dollar index, there's that 92 level. That 92 level is key. If we start to dip below that, that's a big boost to a big sign that investors are really starting to flock to those international regions. Because when you hold something like an EEM, you're not currency hedged. So what that means is when the dollar strengthens, it hurts your returns if you're holding EEM. But if it weakens, it contributes to your return. So that's something to keep an eye on there as well.
Right, which is another reason why at the Bauman letter, for example, we often and have bought offshore companies. Partly because when you buy a company that's when the dollar is strong, you're getting it at a cheap price because the earnings of that company are coming in a currency that is relatively lower than the dollar. When the dollar subsequently weakens, it raises the value of those earnings, those offshore earnings, which in turn tends to boost the share price of the company because its earnings are relatively more valuable in dollar terms. So it's not just the ETF. So again, as I've always said, folks, go and have a look at those ETFs on your favorite market website and look what their holdings are, and maybe go direct and buy some of those companies directly if you can, because you do get that currency scenario. And of course, this could be particularly strong if we end up with a serious contestation period over the next 6 weeks or so, because the dollar could really suffer then, and it would make some of these companies very attractive, from the earnings hedging perspective. So that's one thing to do. Anything else, Clint? I mean, you care to make any predictions at this point, or are predictions no longer a safe game to play?
Predictions have never been a safe game to play.
You got to play it. You got to play it.
But I think the one thing I would watch too right now, from a broader stock market standpoint, it's something I talked about the other week, and that's high yield spreads. Spreads on junk bonds. Whenever they're falling, that's a good sign that those investors in high yield bonds are feeling better about the outlook, and vice versa when they're rising. And we've kind of carved out this level that these spreads have refused to break below for the last several months. But when I did my last check this morning, we're starting to see those spreads come down even more. So we keep seeing those spreads break down here. That's in general a good sign for the markets.
It is. In fact, there's a short-term play that I would recommend viewers check out, and that is to look at closed-end funds that hold corporate debt, for example, or that hold any kind of assets that are sensitive to the economic scenario in the United States, particularly credit markets, because they continue to be significantly undervalued relative to their net asset values. In other words, the values of the assets that they themselves hold. And right now, you can get yields well over 5%. You can lock them in right now by buying them. And most of these closed-end funds that are reporting this quarter are showing pretty good results. The same goes for some real estate investment trusts, particularly in the retail space, where people had flocked away from them. They're starting to report, they're starting to resume dividends. And that is very bullish for their short-term stock prices. So remember, there are some short-term gains to be made in odd places. It's not all just about the technology sector. Anyway, folks, that's it from us this week. Don't forget, you can subscribe to the Bauman Letter by clicking the links below. I keep meaning to say that at the beginning of the video, but it just goes to show you I'm more focused on sharing ideas with you than I am on selling newsletters, which my publisher is going to probably tell me about after I get off this call. But anyway, please, we'd love to have you. We're doing extremely well. In fact, our portfolio is just up shockingly at the moment. We've made some big profitable trades in the last while, both in the Bauman Letter and in our profit switch, which is a more specialized portfolio. And we're starting to acquire new companies that are looking to break out. That's what we try to do with that one. So until next week, we'll see you then. Clint, have a good one.
Thanks, you too.